What if I told you that the secret to building wealth isn't about luck, high-risk investments, or having a ton of money to start with? What if the key is something much simpler, something that one of the richest men in the world, Warren Buffett, has mastered? Warren Buffett, the Oracle of Omaha, built his fortune not through lottery tickets or get-rich-quick schemes, but by following a set of timeless investment principles. He started as an average kid, obsessed with numbers and business, and turned his passion into an empire worth over $100 billion. But here's the thing. His strategy isn't a mystery. It's something anyone, including you, can follow. So if you're a beginner looking to start investing, let's dive into Warren Buffett's step-by-step approach to building wealth the smart way. Warren Buffett's journey into the world of investing started earlier than most. At just 11 years old, he made his first stock purchase, buying 3 shares of Citi Service Preferred for $38 each. It wasn't a massive investment, but it was his first step into the stock market. He watched nervously as the price dropped to $27, and he resisted the urge to sell. Eventually, the price rebounded to $40, and he sold his shares for a small profit. However, he later regretted this decision when he saw the stock climb to over $200. This was his first real lesson in patience, something that would define his investing career. Buffett quickly realized that the real power of investing lies in time and compounding. If you start investing early and let your money grow, the results can be extraordinary. Think of compounding like a snowball rolling down a hill. At first, it's small, but as it continues rolling, it picks up more snow and grows exponentially. This is exactly how Buffett turned a few dollars into billions, by allowing his money to work for him over time. One of Buffett's key principles is to invest only in businesses you truly understand. He has always been vocal about avoiding complex investments that seem too good to be true. Many people, especially beginners, get caught up in market hype. They hear about a new trend, like cryptocurrency or NFTs, and rush to invest without fully understanding the risks. Buffett never fell into this trap. In fact, he famously avoided tech stocks for years because he didn't fully grasp how they worked. Instead, he focused on industries he knew inside and out. Companies that produce real, tangible products that people will always need. Take Coca-Cola, for example. Buffett first invested in Coca-Cola in 1988, and he still holds onto those shares today. Why? Because he understood the business. He knew that people would always drink soda, and that Coca-Cola had a brand that would stand the test of time. Instead of chasing short-term trends, Buffett sticks with companies that have strong fundamentals, steady growth, and a reliable customer base. Another key lesson from Buffett is the importance of patience. Most people enter the stock market expecting to make quick money. They buy stocks hoping for immediate gains and panic when prices drop. But Buffett sees investing differently. He doesn't buy stocks, he buys businesses. And when you own a business, you don't check the price every 5 minutes. You focus on its long-term potential. Buffett's philosophy is simple. If you wouldn't feel comfortable holding a stock for 10 years, don't even think about owning it for 10 minutes. He believes in long-term value investing, meaning he buys stocks in great companies and holds them for decades. This mindset separates true investors from gamblers. When the market crashes, most people panic and sell, but Buffett sees it as an opportunity to buy more at a discount. Let's talk about another fundamental Buffett principle: buying stocks at a discount. Imagine you walk into a store and your favorite sneakers are on sale for 50% off. You wouldn't hesitate to grab them, right? Buffett treats stocks the same way. He never buys at full price. He waits for great companies to go on sale. This concept is called the margin of safety. It means buying stocks when they are undervalued so that even if the market fluctuates, you're still in a good position. How do you know when a stock is undervalued? Buffett looks for companies with strong earnings, low debt, and a competitive advantage. He reads financial reports, studies the company's management, and determines whether its stock price is lower than its intrinsic value. This method has helped him avoid bad investments and focus on businesses that will continue to grow for years. Buffett also strongly advises against using debt to invest. While many people borrow money to trade stocks, Buffett sees this as an unnecessary risk. He believes that debt can be dangerous, especially during market downturns. If you borrow money to invest and the market crashes, you could lose everything and still owe money. That's why he preaches financial discipline. Instead of relying on debt, he encourages people to save, live below their means, and only invest what they can afford to lose. Another major reason why Buffett is so successful is his ability to stay rational in any market condition. Investing is an emotional game. When stock prices rise, people feel greedy and want to buy more. When prices drop, fear takes over, and they rush to sell. But Buffett remains calm no matter what. He often says, Be fearful when others are greedy, and greedy when others are fearful. This means that when everyone else is panicking and selling, he sees it as an opportunity to buy great stocks at a discount. For example, during the 2008 financial crisis, most investors were terrified. The stock market was crashing, and people were pulling their money out. But Buffett, he was buying. He knew that strong companies would recover and that this was the perfect time to invest. And he was right. The market bounced back, and Buffett made billions by staying calm and trusting his strategy. Another key to Buffett's success is his commitment to continuous learning. Even after decades of investing, he still spends most of his time reading. He believes that knowledge is the best investment anyone can make. Buffett reads financial reports, newspapers, and books every day to stay informed and make better decisions. He once said, "The more you learn, the more you earn." For beginners, Buffett recommends reading The Intelligent Investor by Benjamin Graham. This book teaches the fundamentals of value investing and how to analyze stocks like a pro. He also suggests Common Stocks and Uncommon Profits by Philip Fisher and One Up on Wall Street by Peter Lynch. These books provide valuable insights into picking great stocks and thinking like an investor. So, if you want to follow in Buffett's footsteps, start by developing the habit of reading and learning about investing. The more knowledge you gain, the more confident and successful you'll become. Now, let's summarize Buffett's blueprint for beginner investors. First, start as early as possible to take advantage of compounding. Invest only in businesses you truly understand and focus on long-term growth rather than short-term gains. Be patient and disciplined. Don't let emotions dictate your decisions. Always look for undervalued stocks with a strong margin of safety. Avoid debt, live below your means, and only invest what you can afford to lose. And most importantly, never stop learning. The more you educate yourself, the better investor you'll become. Buffett's strategy isn't about quick wins or overnight success. It's about making smart, calculated decisions that pay off in the long run. And the best part? You don't need millions to get started. You can begin with whatever you have and build your wealth step by step. So, are you ready to start investing the Buffett way? If you found this helpful, hit that like button and subscribe for more investing tips. Let's build wealth the smart way, one investment at a time. Thanks for watching, and see you in the next video.